This is Macro Voices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Macro Voices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Macro Voices episode 52 was recorded on March 3rd, 2017. I'm Eric Townsend. Real Vision co-founder and author of the popular Things That Make You Go newsletter, Grant Williams, joins me as this week's featured interview guest. We'll be discussing the global rise in populism, where the trend is headed, and what it means for markets, Donald Trump's presidency, the U.S. dollar, gold, and much, much more.
And I'm Patrick Ceresna. Eric, that S&P 500 exploded higher on Trump's speech all the way up to the 2,400 level, and now has given back almost half of that. What's your feeling about the S&P here?
Weren't we just last week or the week before announcing the big news that it broke above 2,300? So it was at 100 points a week. It'll be 2,500 next week. What this reminds me of, Patrick, is the summer of 1999. What happens in the final stages of a bull market is you get to this crazy stage. Remember when tech companies didn't need revenues or earnings or even customers or even a viable business plan? Just page views was enough to send valuations to the moon. People were talking about a new economy. Suddenly the old metrics didn't matter anymore, and this time was different and all that. Now, I wanted to short tech stocks in the summer of 99. Thank heavens I didn't do that. And the reason is I had just sold. I was a software entrepreneur. I sold a software company in the summer of 98. And I knew, there was zero doubt in my mind, that we were in a bubble, in the late stages of a bubble. But what would have happened had I shorted tech stocks in 99, in the summer of 99? They had another 50% to move to the upside before it all finally blew up in 2000. So the rule of thumb here is these things go on longer than most of us skeptics think is possible. And who knows how long it can go. I do think that we're seeing a lot of signs of being in the final stages of a bull market where retail investors are piling in. There was a massive, massive inflow last week of over $8 billion in a single week into the SPX ETF. So we're seeing these signs of just irrational exuberance, people piling in while the smart money is quietly selling. At least that's my belief as to what's happening here. How long does it go? How much higher do we move in this market before reality sets in? I don't know. I have no way of knowing. So you definitely don't want to be short this market because the trend is very strongly up. I personally am not a momentum trader. I don't want to try to trade this. If I were going to try to trade the upside, it would be with calls, because I think at some point this party's going to come to an end and it ain't going to be pretty. Trump and the Fed can definitely influence how this will end and how long it takes before it ends. But it's going to end. It's inevitable. And when it does, it's not going to be pretty.
All right, now let's move on to that dollar index, because the U.S. dollar index just broke out above the 102 handle. Again, just strength right after that Trump speech. Is this the breakout?
I think it is. It's interesting. I'm seeing a lot of smart people with an opposing view saying that they really think Trump is going to find a way to contain the ascent of the dollar, stop it. And I think that's a very, very good intuition that Mr. Trump understands that he needs a weaker dollar. He's smart enough to get it. But I don't see any actions that he's taking yet that are going to produce that outcome. So far, it's just jawboning. So I do think that what we're seeing is a move back to the upside. We really need to see north of 103 to really confirm for me that the trend has changed. But it sure looks like it's headed in that direction. I think Grant Williams is probably going to have an opposing view, so stay tuned for a different perspective on this.
Now let's talk about crude oil. Now crude oil once again tested up toward that 55 level, and then a big sell day today, dropping it down to the 52 handle. We've been talking about, when is this breakdown going to actually occur? Is this it?
I think that it's upon us. I do think that 55 was that key resistance level. A lot of people thought that maybe on inventory day we'd get a breakout above that. We had a brief test at 55.03, did not break out above it. And, now we're back down to the bottom of a short-term channel, and I think that we are set probably to head at least to, let's say, a 45 or so on West Texas Intermediate if this trend continues continues. Now, of course, there's a caveat there, which is that we don't yet know what Donald Trump's intentions relative to ISIS are. If there is a sudden bombing campaign in the Middle East, that will change everything. But failing that, I think we have seen this resistance be tested a couple of times. I think the market very firmly rejected that 55 level. And we remember we're looking at, in terms of number of contracts, all-time record high speculative long interest. That means that if this sell-off continues, that money's going to get squeezed out. It's all hot money in those oil futures, and they're going to be forced to cover their losses, close their positions. Selling begets more selling. Before you know it, we're looking at 45. So I'm definitely bearish. The one caveat, again, is we don't know what Donald Trump's intentions with ISIS are going to be. I have a theory about how that could play out. I'll save that for the feature interview with Grant Williams.
Oh, absolutely. Now, I want to move on to gold. Obviously, in the face of that U.S. dollar breakout, gold's inverse correlation just immediately kicked in, and we are already $20 off this high point that it was at just a few days ago. What's your feeling about gold here?
Well, I'm still on hold because of my long dollar index view. And it's coming, as far as gold itself, what's happening with miners or, gold fundamentals, I'm not even paying attention to that. What I'm doing is I'm looking carefully at my reasons for having a bullish view on the U.S. dollar. As long as I am still bullish on the U.S. dollar, I'm going to pass on gold here. I'm not necessarily bearish, but I think the strong dollar, especially if it strengthens toward 110, which I think is likely on the dollar index, then, that's an awfully strong headwind for gold. If you're one of the people that really believes Donald Trump is a madman who's going to start a nuclear war, well, then you want to have physical gold in your possession so that it can be vaporized with you when the bombs land. But, short of that, I don't really see the strong argument for gold. The thing is, if I'm wrong about the dollar index, if the many people, including Grant Williams, who see it the other way and think that the dollar is done here, then that will mean I missed the bottom on gold and will definitely regret it. I actually called that bottom to the day almost, and then by the time it hit, I had changed my view and I didn't buy it. So I hope that I didn't miss a final bottom there at 1124. We'll see what happens, and I think the only way that we're going to go substantially higher from here is if I'm getting the call wrong on the dollar. The dollar really is about to roll over, as a lot of smart people think it is. In that case, I missed the bottom in gold, and I will definitely regret that.
All right. Now, interest rates have been under quite a bit of pressure here as the 10-year yield has now once again approached that 2.5% level. What do you think's in store for bonds?
Well, I think this is entirely about the explosion in rate hike expectations. A week ago, the implied probability of a March rate hike from the FOMC was something like 20%. Now it's something like 80%. And of course, there have been 4 or 5 hawkish speeches from Fed governors in the last week. So all of a sudden, the 10-year is backing up toward 2.5%. No surprise there. I think it's entirely about rate hike expectations. And we have been down to 2.3%, back when the rate hike expectations were implied at 20% instead of 80%. In the big picture, though, I still think we're treading water here. We haven't seen a crossing of any of those red lines in the sand that some of the famous people like Bill Gross and Jeff Gundlach have drawn, but we haven't seen the move in the other direction either. I definitely want to ask Grant Williams about this because I know he's done a tremendous amount of analysis and writing over the years about this massive problem of too much sovereign debt.
Oh, absolutely. Well, thanks for that market update, Eric. This week, we're happy to welcome back to the show Grant Williams. He is a portfolio strategy advisor for Volpez Investment Management, and he's the co-founder of Real Vision Television and the author of the Things That Make You Go newsletter. Also, stay tuned after the interview as Eric and I will be back to talk about options writing in a portfolio as an asset class. Eric's interview with Grant is coming up as Macro Voices continues right here at macrovoices.com.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me next on the program is Grant Williams, Real Vision co-founder and, of course, author of the extremely popular Things That Make You Go, newsletter. Grant, your views on the global rise in populism have been among the most prescient of any guest who's appeared on this program. You predicted the Brexit outcome, and you've described the rise of Donald Trump, Bernie Sanders, and various European politicians, including Marine Le Pen, as all being part of a connected global trend. Since our last interview, many of your predictions have come true. So bring us up to date on your outlook. What is driving the global rise in populism? What does it mean, and what's coming next for Europe, the United States, and the rest of the world?
Hey, Eric. Well, it's great to be back on and good to speak to you again. The populism thing is so interesting, and I think it's so important right now. And I think, me predicting Brexit and Trump, that doesn't make me any great market seer. I think the beauty I had during those election campaigns was that I was in neither place. So I could sit back from a distance and look at it objectively, which I think both of those, the Brexit situation and the US elections, were so just electrified with high feelings on both sides. And it was really difficult, if you were in the middle of that, to be able to be objective about it. And so I think with the Brexit, the Brits have always had a kind of tenuous relationship with Europe. We were never really in the EU. You could just sense that when push came to shove, a lot more people were going to vote leave than perhaps admitted. And I think once we saw what happened in the UK, from traveling around the US a lot, which I've done the last couple of years, it became really obvious to me that the phenomenon that we saw in Brexit was very much that if you're a vote leave guy, you don't talk about it at dinner parties. It's just not socially the done thing in England. And so the polls kind of missed out that a lot of people weren't really were saying they were undecided, or they're saying they were going to vote stay when really they were going to vote leave. They just didn't want the social stigma. In the US, what was interesting to me as I traveled around talking to people, it was obvious that they were going to take that a step further, because to say that you were a supporter of Donald Trump, you were immediately labeled with every kind of ist that you don't want to be. You were a racist, a misogynist, you were a sexist, you were all these things. And so not only did people not just say they were voting for Trump or they were undecided, the very thought that you might be undecided and be thinking about voting for Trump in a certain kind of company was enough to kind of tie you with all those things. So I think people actively said they were going to vote for Clinton, because that was the more socially acceptable thing to say, whether you believed it or not. And so when people went into the poll booths, pulled the curtain behind their backs, it was much easier for them to vote their conscience. And when you look at, there are two maps on the internet. If you Google Trumplandia and the Clinton archipelago, you'll see the two most striking maps that I've seen regarding the US election. And yes, we know Clinton won the popular vote, but if you look at these maps, it shows county by county the entire country. And it shows the strength of the vote for each candidate. And if you look at the map of America, the strength of the vote right across the middle of the country for Donald Trump was extraordinary. And then you flip the page to the Clinton archipelago, and you see just a rim around the edge of the country, which obviously includes the places like Los Angeles and San Francisco and New York and all the big cities where there's heavily concentrated populations. That's where Clinton got the vote. So you can see, looking at that map, that the groundswell of support for Trump was extraordinarily broad and remarkably deep. So that's kind of where we are in terms of going forward from here. Well, we're going into election season now in Europe, and we've got some big ones coming up. The Dutch go to the polls in a couple of weeks' time. The big one is the French poll in May, and then further off in the distance, we have the Germans going to the polls in October. And my concern right now is that optically, to those people going to the polls in Europe, the UK looks like it's doing pretty well, having left the EU. We've seen the economy actually pick up. It was the fastest growing economy in the G7. I think it may have slipped to second place now, but it's done optically very, very well. And there's been no real fallout from Brexit other than the positive variety. So anyone going to the polls in Holland is going to look at the UK and say, well, the Brits have done okay outside Europe. And anyone going to the polls in France is going to say, well, yeah, you know what, the old Brits don't seem to be doing too bad. Now, the Brexit effect may work its way through the snake and come out in the British economy later this year, but by then it'll be too late. So, I think Le Pen is going to struggle to win, to be honest with you, but French politics is such a snake pit, and we've seen already what's been happening to Fillon and his wife being taken into custody yesterday. So really anything could happen, and Le Pen winning would surprise a lot of people. I don't think globally it would be as big a surprise as the election of Donald Trump was. But I think in Europe, if Le Pen was to win, and we're seeing this reflected in spreads of the Oats over the German Bunds, if Le Pen was to win, it would really rip the core away from Europe, and it would be a real problem for the Eurocrats to try and keep that thing together. So I think, as I say, we go into the season now, this populism trend, it really isn't over, and it's not going to die down now that Trump has been elected, particularly as he's gone straight into power and has done things that his base are loving. There are easy things for him to do. He's doing what he promised. And so if you are a populist, you've got a pretty good tailwind at the moment. And that is destabilizing for the world. It increases volatility in the world. And those, generally speaking, are two things that markets don't like, although you wouldn't know that right now as this Trump rally goes on. So I think we're going to see more of this populism. I don't think we're going to see the sort of the left, the status quo coming out in their millions to vote and keep the status quo. I think the agitators are going to be emboldened by what they've seen overseas. And I expect this to continue in Europe. And I think the Dutch referendum, the Dutch election in the next few weeks is going to be the start of that. And I suspect Wilders will win and run on a very anti-EU, anti-Euro platform. So Europe has another summer of love coming, and I think markets need to be ready for it.
What do you think the core driver is for all of this? Because a lot of people have said, well, this rise in populism is just because everybody around the world is frustrated with the global elites and the government and so forth. But if you look at it, really, it's not, the government against the people. It's the people dividing. And you saw it in the case of Brexit in the UK, as you described. You see it again in the United States with the Clinton versus Trump thing. There is no moderates left. Everybody either thinks that if you didn't vote for Hillary, you should be hung by the neck until dead, or it was your God-given, duty to vote for Trump because he's the savior. We get such divisiveness with people so polarized with opposite views. How did that get started, and what does it mean? Because I can't help but think, we've talked about war in our past interviews, I can't help but think, what causes a war? When people have irreconcilable differences, extreme views. Is that where this is headed, and what do you see coming next?
Well, it's tough to say that's where this is headed, but suddenly, after a few short years, you can now say with a degree of certainty that's where this could head. That was a possibility that few people were willing to entertain just 2 or 3 years ago. And now I think we can all see a clear path to how we could accidentally fall into some kind of major conflict. And I think the start of this, you're absolutely right in what you say, Eric. I mean, this is not the government against the people. This is the people divided. And that stems from this massive surge in inequality that we've seen, which, I'm sorry, I hate to go back to this, but I think a lot of this can be laid at the feet of the central banks and the policies they've enacted to try and quote unquote save the system. The system is essentially run by the haves. They're the guys that fund the system. They have the capital. They're the guys whose money is sloshing around the system, so to speak. And so by saving the system, you are saving the people that have wealth. And what they've done is made those people a lot wealthier. And you can look at the charts about there's that great stat recently about the 8 guys have the same amount of money as 90% of the world's population. It's insane for these things to happen. But ironically, as the central banks and the governments have tried to keep the lid on this, they've done so by telling everybody how well everything's doing, how everything's getting better, and they're making great strides, and everything's coming back, and the economy's coming back, and the jobs are coming back, and that's not true. And at the very best, it's kind of putting lipstick on the pig. And so people are listening to that on the one hand, but they're not seeing it in their pay packets. They're not seeing it in their cost of living, which is going up. They're not seeing it in the cost of healthcare. They're not seeing it in all the expenditures that they have to make. And the non-discretionary stuff is going higher. And they feel frustrated because they feel like they're being lied to and told everything's getting better. And they're thinking, well, if it is getting better, it's not getting better for me. So it just amplifies this divide between the haves and the have-nots, because the haves, they're not struggling. I mean, the guys that have assets and have capital have done incredibly well since the era of quantitative easing began. So they're not feeling this. I mean, they probably might sit around at dinner parties and talk about, hey, isn't the cost of a holiday in, the south of France going up this year? but it's not. They're not feeling it. You know, they're kind of seeing it and they're experiencing it, but they're not feeling it. Whereas at the other end of the economic scale, these guys are struggling, and there haven't been any wage increases, and the cost of living, the CPI is not 1%. You know, the things you need, it's a lot higher than that, and so they feel like not only they're being lied to, but their inherent faith in anybody in a suit and tie behind a microphone is such that when those guys are saying, you know, it is getting better, things are on the up, they think, well, they're telling the truth, so that just means it's other people that are doing better than me. So I completely understand where this is coming from, and I really do think that this is an extension of central bank policy, of eviscerating the middle class in an attempt to save, quote unquote, the system. And I think when history looks back at this, we get the denouement of this era of central bank omnipotence. History is not going to be very kind to these guys, and I think justifiably so.
On that theme of asset markets doing well in this environment, let's go back to Donald Trump in particular, because the stock market is telling us that all of President Trump's aspirations will be realized. The economy will be great. Corporate profits will go through the roof thanks to his tax cuts. The protectionist policies that he's threatening to impose won't pose any serious problems. And his habit of infuriating entire governments and their peoples, notably Mexico and China, are apparently no cause for concern. Now, personally, Grant, I'm a little bit more pessimistic than that. What's your view? But more importantly, what the heck is going on that markets or investors in general are seeing this is unconditionally positive? And we've got what has to be the most contentious U.S. president of our lifetime. I mean, how could that be happening?
Yeah, I'm totally in your camp, Eric. And I think, again, I hate to keep harping on this, but if you look for the linkages, they're very, very clear. I recently gave a presentation in South Africa, and in that presentation, I was talking about volatility and how volatility has repeatedly been crushed ever since Mario Draghi's Whatever It Takes speech. And I spoke to a brilliant guy called Chris Cole at Artemis Capital about this, who's one of the best vol traders in the world. And you know, when I spoke about this, it's clear that the central banks have actively sought to dampen volatility because volatility makes skittish markets, and skittish markets are unpredictable. And so when you get the Trump trade coming on, we all knew going into this, we all knew what the potential downsides were. And I think often when you see